And you thought the 2008 bubble was bad. Well, we're in a double bubble or mega bubble according to the guy that predicted the first bubble in 2008. That's right, Michael Burry is saying that we're in the most speculative bubble of all time by the magnitude of 2 times. So that's a pretty big statement. In this video, we're going to dive into some of the metrics that he's quoting so we have a reference point, and then I'll give my commentary on the whole thing and kind of how I interpret it. Precursor to the bubble tweet, Michael did mention some metrics that worried him back in February, such as the US government inviting inflation with its modern monetary theory policies, a larger debt to GDP ratio, and then also increases in the M2 money supply. If you're not familiar with modern monetary theory, MMT, the gist of it is that government debt isn't an issue and that the government, if it owns its own currency, can spend more than it's collecting in taxes. So the debt isn't really a concern when you ask someone that believes in MMT, and then it also essentially says we can run greater deficits without really any issues. What do you mean we don't have any money? We print the money. With all the money printing going around, you can look at the M2 money supply, which is a concern for Michael Burry because you can see a parabolic move in 2020 going into 2021. The M2 money supply is expanding and there is a fear of possibly hyperinflation. If we look to the CPI report that came out for May, we saw a 5% increase, which is a larger number, but we do have to remember that the base was a little bit lower. And then you have things like energy and used car sales, which have spiked significantly, which may inflate these numbers. The Fed and a lot of other people think that the inflation is transitory, whereas Michael Burry thinks it's more secular and that it may cause issues down the road. The survey I was referring to was done between June 4th and June 10th, asking 224 fund managers their opinion on inflation. Around 72% said inflation was transitory, while 23% said it was permanent. What's interesting is this statement down here, which is exactly how I'm positioned, mostly in growth, while I also have positions in commodities, cyclicals, and financials, with the expectation that the Federal Reserve kind of tapers their policies over the next couple of years. Burry is also concerned with the debt versus GDP. We can see since the 60s it has slowly risen, but now we are way above 100% as a percent of GDP. Now with MMT, it basically said the debt doesn't really matter and that the government can keep on spending. Burry obviously believes that this is an issue because he talks about the debt and over leverage in the economy a lot. Something that wasn't mentioned, but I did want to bring up is that margin debt is near all-time highs. If you look at March 2020, we had a dip in total margin debt, but since then we've seen a steady increase and it's surpassed the levels 2018. The market is clearly getting more leverage as well in terms of taking out debt and using that to invest. We have some common themes here. We have over leverage and a concern over inflation. Now, if that does cause a crash, let's talk about that. When in doubt, zoom out. In 2000, we crashed and then we recovered. In 2008, we crashed and then we recovered. In 2012, if you sold everything because you thought another crash was coming, well, you missed out on a huge run. Time in the market is better than trying to time the market. Of course, you have situations where there's specific stocks that are extremely overvalued and are at nutty valuations. That's always going to happen. But if we're talking about the general market, if there is a crash, it's usually a great buying opportunity for the long term. So let's start off by saying that. With all the margin debt out there in the stock market and concerns about overall debt, if we do have a sell-off, I think it would be a faster crash. But once again, if you are a long-term investor in something like an index fund, that should be a buying opportunity. In regards to the hyperinflation concern, well, that's not really good for anyone. Unless you're all in on Bitcoin, baby. Oh wait, that's down a lot too. Never mind. If we do have higher inflation, it's still good to be in assets like the stock market that should rise with inflation. I'm not selling everything and converting into cash because cash is terrible if there's hyperinflation. So for me, allocating a portion of your portfolio to inflation-resistant products or investments makes more sense than selling everything and hiding all your cash under the mattress. I'll admit one metric that I believe is helping the stock market or prop it up is this federal funds rate close to zero. So as long as that's close to zero, I don't think that the market is going to crash. The Fed meeting, they talked about possibly raising it at the end of 2020 2023. That's a couple years out. Of course, the market can move down before they actually raise the rates, but until they actually do that, because they kept on saying everything is dependent on data, if they keep these federal fund rates close to zero, I still want to stay invested in the market. Now, 2 days later, Michael Burry did send out 2 more tweets, and I know his name on Twitter is actually Cassandra. I don't fully understand that one, but this is Michael Burry. And the 2 tweets called out 2 specific markets, the crypto market as well as meme stocks, calling them over-leveraged. Here, he says that crypto is over-leveraged and that the meme stocks are insane and that the crash or the hype and speculation won't go sideways, it will crash downwards. Now, this one I can get behind because I totally agree with him that the meme stocks and some cryptocurrencies, right, the meme coins or the shit coins that don't have any purpose, they have potential to crash. And with all this margin debt, or you have leverage in the crypto market with people trading, you can have this huge domino effect that increases the rate of a crash. So AMC trading at a 20 billion valuation, I know, don't hate on me, all of the AMC army, but if you're looking at a fundamental viewpoint of these companies, they're not worth nearly as close to what they're trading at. So if AMC comes back to, $10 per share, that makes more sense. When Michael Burry is talking about a crash in the meme markets of cryptocurrency and stocks, that makes more sense versus a stock like McDonald's, which has ran up in price and valuation, but is it going to crash 60% overnight? Probably not. And if it does, I'm buying that dip. Michael Burry is an intelligent man, there's no denying that. But the market can stay irrational longer than you can stay solvent. So I think shorting the market heavily or selling everything doesn't make sense for the common investor. So as long as you're, confident in that the individual companies that you're invested in aren't extremely overvalued, if you're taking a long-term approach and maybe you buy puts to hedge your portfolio, or you allocate slightly more towards inflation-resistant products versus selling everything. There you have it. That's my opinion on Michael Burry's tweets and what I think about this whole doom and gloom thing. If you did enjoy this video, give it a thumbs up and consider subscribing to Main True Wolf, where we talk about personal finance and investing, anything to do with money. Thanks guys for watching, and have a great day.